Hey there, and welcome back to the Young Investor Podcast. I'm Ali, and today we're diving into a silent shift happening in global supply chains. Over the past decade, we've seen companies quietly move their operations away from China towards emerging hubs like Turkey, North Africa, and Central Asia. But what's driving this change? And more importantly, how can young investors like you capitalize on this trend? Today, we're going to unpack the reasons behind this shift, explore the emerging hubs, and highlight some exciting investment opportunities. So, grab your notebooks, and let's get started. Let's start with the big question. Why are supply chains shifting away from China? Well, it's a mix of geopolitical tensions, rising labor costs, and lessons learned from the COVID-19 pandemic. You see, the US-China trade war that started in 2017 imposed tariffs that made manufacturing in China more expensive. On top of that, China's rapid economic development has led to rising wages, especially in coastal manufacturing hubs. This erosion of cost advantage has companies looking for cheaper alternatives. And let's not forget the COVID-19 pandemic. It exposed the vulnerabilities of having over-concentrated supply chains. Companies realized the importance of diversification to mitigate future disruptions. So, they're now looking at regions offering competitive labor costs, strategic locations, and improving infrastructure. But what exactly are these regions, and why are they becoming the new hotspots? First up, we have Turkey. Strategically located at the crossroads of Europe and Asia, Turkey offers competitive labor costs and strong trade agreements. It's a manufacturing and logistics powerhouse, with sectors like automotive, textiles, and electronics thriving here. Companies like Koç Holding and Ford Otosan are already reaping the benefits. Next, we have North Africa. Countries like Morocco and Egypt are becoming key players in automotive manufacturing and renewable energy. Morocco, for instance, hosts Renault's largest African plant. The region benefits from its proximity to Europe, lower labor costs, and supportive government policies. Lastly, Central Asia, particularly Kazakhstan and Uzbekistan, is rich in critical minerals like rare earths and copper, essential for green energy technologies. The region is also a vital link in the Belt and Road Initiative, although this comes with its own set of challenges and risks. But it's not all smooth sailing. Political instability, inflation, and infrastructure gaps pose significant challenges. So, where are the investment opportunities in this shifting landscape? Let's start with public companies. In Turkey, Koç Holding is a diversified conglomerate with interests in automotive, energy, and consumer goods. In Morocco, OCP Group is a leading phosphate and fertilizer producer. For those who prefer a more diversified approach, there are ETFs like the iShares MSCI Turkey ETF or Frontier Market ETFs that provide broad exposure to these regions. And if you're willing to take on more risk for higher potential returns, consider looking into private markets and sovereign bonds. There's growing VC and PE activity in Turkish e-commerce and Moroccan agritech, and some countries issue dollar-denominated bonds with attractive yields. But before you jump in, let's talk about the risks. Political instability, inflation, and water scarcity are significant concerns in these regions. Infrastructure gaps and logistics bottlenecks can also limit growth potential. So, how do you manage these risks? Diversification is key. Balance your investments across different regions and sectors. Keep an eye on geopolitical developments and regional risks. And remember, higher risk can lead to higher rewards, but it's essential to do your research and stay informed. To wrap things up, the shift of supply chains from China to Turkey, North Africa, and Central Asia is a transformative trend with significant implications for global trade and investment. For young investors, this presents a unique opportunity to diversify portfolios and capitalize on emerging market growth. Some actionable insights include starting with ETFs for broad exposure, then add select stocks for targeted growth, monitoring geopolitical developments and regional risks closely, considering infrastructure and logistics investments for long-term growth, and using sovereign bonds and private markets for higher risk-reward opportunities. Thanks for tuning in to the Young Investor Podcast. If you found this episode helpful, don't forget to subscribe to our channel and to our Young Investor newsletter on Substack and leave us a review. Next time, we'll be diving into the world of critical minerals and their impact on green energy investments. Until then, stay curious and happy investing.